Is high executive turnover an unintended consequence of M&A? A new study from Virginia Commonwealth University says target companies have an abnormally high turnover ratio in the first 10 years after a deal. Jeffrey Krug co-authored the study. He joins us. He's an associate professor of strategic management in Virginia Commonwealth University. And Bob Profusek is global chair of mergers and acquisitions at Jones Day. Gentlemen, nice to have you on the program. Welcome.
Good afternoon.
Thank you.
So, Mr. Krug, let me kick it off with you. You say that turnover is a direct result of M&A. Makes sense. The question we're trying to figure out is M&A actually good for shareholders and companies in the long term? What have you found?
Well, I think the evidence is pretty clear that roughly one half of mergers and acquisitions fail to live up to expectations of the companies making the acquisitions. And the evidence is pretty strong that in the first 2 years following an acquisition, a target company can expect to lose about a quarter of their executives in the first year, an additional 15% in the second year. And that's a turnover rate of about 3 times higher than normal.
Yeah, but can you really say, I mean, isn't that really generalizing there, sir? I mean, with all due respect to the study, the bottom line here is some companies acquire wrong companies. Other companies will acquire companies that are very synergistic. Can you really say that all deals, for the most part, are showing the same thing?
Well, on average, yes, I can. In fact, I've been compiling data for more than 10 years. I've analyzed the careers of about 23,000 executives in more than 1,000 target companies, and on average, these turnover patterns are pretty consistent. What is, I think, more dramatic is the fact that this turnover pattern continues for 10 or more years following the acquisition. And this is counter to the conventional wisdom that turnover tends to return to normal after 2 to 3 years after the acquisition.
That's fascinating. Bob, in some cases, though, a change in management is really part of the M&A process, right? I mean, in order to do a deal, you've got to reposition people, put people in other areas, and avoid overlap, no?
Well, I agree with that. The idea in many mergers is so-called synergies. Even in a down cycle like we're in, there's probably $3 trillion of M&A a year. The notion that people are spending that kind of money unwisely year after year after year, I think is really quite questionable.
Jeffrey, what do you have to say about that one?
Well, I mean, there have been a variety of studies looking at the performance effects of acquisitions, and the evidence is extremely strong that the larger the turnover of executives in the first couple of years after the acquisition, the lower the levels of performance. And the reason for that is that oftentimes you have executives who have 20 to 30 years of industry and firm-specific knowledge, and the company is losing those executives, and you're losing in the process a lot of capabilities. So I agree that sometimes you have overlapping or complementarities there that can be eliminated. But in the long run, you want to restore leadership stability within your target company, because that's a very important process of driving the company toward a stable long-term performance.
Really fascinating stuff, gentlemen. Thanks so much. We appreciate it.
You're welcome.
You're welcome.
We'll see you soon. The markets may be closing.